the U.S.-Iran tensions are rising, and I want to talk about my CL options plan, which I'm looking at short puts, obviously in this case, but it depends on the situation. Things are changing by the day here, and the price of crude oil went up 4.5% just 2 days of making this video. So the reasons for the price to increase is the basically U.S. and Iran escalations and deal talks failing, which is very likely to happen. We have Israel that really wants to attack, and we have a lot of U.S. military buildup around Iran, and Iran just kind of trying to, I guess, flex that they can really disrupt the Strait of Hormuz, where like 20% of total global oil is going through, right? So it will be a huge hit to oil if things escalate, which unfortunately they will probably will. Given the extreme regime in Iran, and if you guys didn't even know, the negotiations currently are not even done in the same room. So in the same room between the U.S. representative and the Iranian representative, because the Iranians, they don't want to be in the same room as an American. So it's pretty crazy. So there's a guy going from one room to another, and someone from Oman, and he kind of tells one representative and the other what the other one said. So it's pretty crazy. So things are not going to work out. That's just kind of the way it is with this regime, and things will escalate. And this is why I think the price might go to like $70 or even more. Things can go absolutely crazy, right? And reasons for the price to decrease is we have global oversupply. It's kind of been the narrative for quite a few months. And OPEC is supposedly increasing its output in March. On March 1st, there will be a meeting for the OPEC members, and they will basically tell us, okay, we're increasing our output for the rest of the year or not. But analysts and everyone is expecting them to raise the output, which will increase the supply and add even more supply to the global oversupply. But again, on the other side, we have the U.S.-Iran situation. So my short put plan is very simple. I'm looking at the strike of 50 to 55, around 45 days to expiration, 2 to 3 contracts for every $100K in capital, profit at 50% of credit. I will roll up and out, or sorry, roll down and out if down 50% or more on the position. So we'll see what's going to happen. But obviously, if you make a play like this, you expect price to really go up. So when will I open? It's very simple. If a major escalation will take place, I will open the position, and a major escalation will be basically like an attack on Iran. I will be entering only after a pullback, but again, sometimes things can go up parabolic depending on what kind of escalation we get. So I might just enter as soon as there's some kind of escalation. Things can really go quite crazy. So for crude oil, the price just went up 4.36% today, so almost 4.5%, which is pretty crazy. I'm on the May expiring contract. As you can tell, this is pretty nuts, and we are already, I guess, like relatively high price, but it depends on to what timeline you compare it to. Currently, it's pretty high up, and we had some nice short puts that we did along the way here. We had a short put that we did right over here after a huge pullback, after there has been some escalations in Iran. It was a huge pullback, and we entered right over here, and we were out of the position in a few days. So kind of looking for the same pattern, but here we had a good reason for the price to increase because I was expecting more escalations in Iran, which is exactly what ended up happening. So we'll see what's going to happen. Volatility is pretty high. Volatility went up quite a bit today, so it's very close to the all-time high, or to the 3 months highs. I'm always looking at the previous 3 months, so we're up there. So very good volatility. It means we can collect some good credit. So the closest expiration to 45 days is this one, 57 days. So, in this case, I will go to the graph. We can probably choose, let's just for the example, for the sake of example, probably the $55 strike, which is right underneath the the past lows for the previous few years, and price is currently at 64.79. So if we look at what we can get for credit, and I'm looking at 2 to 3 contracts, so let's just go 3 contracts. So we can collect quite a nice amount of credit, so about 2.3% of the account in credit, and this is again for a $100,000 account, and about 13, almost 14% in margin, so not too bad, right? So we'll see what's going to happen. Obviously, with commodities, when price goes up, volatility goes up. Well, specifically with crude oil, I guess. When price goes down, volatility goes down. So this is the huge advantage that you have when you sell puts on commodities like crude oil. If price goes up, volatility expands. Well, it will hurt the position, but we will be making money because of delta as well, right? But if price goes down, volatility will drop significantly, and it will negate the effect of the delta that we are losing on the position. So the really important thing to note, and something that I've been using, using as an advantage. So thank you again for watching. I'll keep you posted of anything and everything that I do. So we'll see what's going to happen, and I will catch you in the next one.